highest paid part-time job in the world, options training program. And what we're going to talk about is how hedge funds, right, um, use how hedge funds use options to make money. But we're not going to just go into just hedge funds, and we'll kind of get you to understand like how particular trading desks and trading funds, right, use options to make money in the options market. Okay, so I learned this from a person that was a trader. Um, and they kind of really got me to understand. I know two guys that I communicate with on a regular basis. One guy operates out of Puerto Rico. He runs what I call a proprietary trading firm. They're kind of like a smaller prop firm. Got a few $1 million in capital that they use to trade. I know another guy that used to work in New York as a trader. He lives now in Miami. And they kind of got me to understand how traders utilize options. So what we first want to do is kind of understand why we're making this video. Is because as an options trader, I want you to kind of understand where you fit into this particular narrative, and a lot of the mythology that's been put around options trading, primarily by people that are looking to sell you something or to kind of dissuade you from operating in this particular space. And we're going to kind of get into the actual landscape and then kind of move from there. So this is going to be a good video for a person that kind of wants to understand as an options trader, as an individual retail options trader, how you fit into the larger context. Because once you kind of understand that, you can kind of understand how you need to operate to put yourself in the best position to monetize your trading. So one of the mythology that's put around options is that the options market essentially is based around retail traders. And what happens is that the market just sells retail traders options contracts, and those contracts expire worthless. And so the retail trader takes the loss and the market maker makes the money. Okay, so what I want you to do first to understand, I want you to Google something called the CBOE, and that's in Chicago, Illinois, right? It's called the CBOE. When you get a chance, Google that. That is a market for options that exists in Chicago, Illinois. They probably do a volume probably in the few hundreds of millions every day on options trades, right? And I want you to understand is that that marketplace cannot be supported by retail traders. And once you start to understand how these particular funds use options, you'll understand that that is incorrect. Second thing I want you to do is I want you to go and look at Apple, look at their options chain, look at the SPY, look at the QQQ, probably go look at Bank of America, probably go look at, I would say maybe Tesla, and I would say probably go look at Amazon and look at the options chains for all those companies or those ETFs. So I'm gonna go again, look at Apple, look at SPY, look at QQQ, look at Amazon, and look at Tesla. And look at the amount of open interest. And so open interest is going to be people that have decided to buy that contract and sit in that position. And then look at volume. Volume is the amount of contracts that are traded daily on that particular contract. So it's how many people bought and sold that contract within that particular trading day. When you're looking at something like looking at Apple contracts, you will sometimes see 60,000 in volume of one particular strike. You'll see 40,000 in open interest. Retail's not doing that volume. They're not doing those kind of numbers. There's another thing that you can do. There's something called option suites, right? And what they are is that they're information that comes from the exchanges, which is the CBOE primarily, but also from the New York Stock Exchange. And when a big player buys a lot of options contracts, that information goes into these exchanges and gets sent out. So you can have an API integration, you can get that particular information. So I know how to read that what we call option suites and options blocks type information. And so if I'm looking at a particular platform and I see that somebody bought January options for Tesla at, let's say, 650, and they bought 3 million calls, $3 million worth of calls, that's not retail. If I'm seeing that somebody bought Apple 120 strike for January 2022, and they spent 5 million on calls, that's not retail buying that. Because what it means is that somebody bought that group of calls all at one time. Now, what you a lot of times see with smart players, what they do is they'll split up their buy. So you'll see hit what we call the sweep. You'll see $2 million hit on a particular strike on a particular date, right? Then 5 minutes later, $2 million a hit again at another exchange. Then about 5 minutes later, $2 million they hit at another exchange. But there'll be the exact same date, the exact same contract, the exact same strike, exact same expiration, everything. That's the same player or the same firm, but they're buying in different exchanges because they want all those orders to go through at the same time without the market really understanding what they're trying to do. But it shows up in this particular information or this data if you know how to read it. That's not retail that's doing that. So there's been a lot of miseducation or disinformation and a lot of mythology created about the options market, because the first thing you got to understand is that once you Google the CBOE and you understand the size of that particular organization and the kind of numbers that they do on a day-to-day basis, but also on a yearly basis, that can't be supported by retail. So the idea that the options market is just for a retail place where retail gets their money taken by market makers is ridiculous. And the idea that if you're selling options, you're in the preferred position, and if you're buying options, you're the sucker, it doesn't make a lot of sense. And I'm gonna kind of explain that to you why it doesn't make sense. So let me give an example. Let's say you and I are working at a trading desk for, let's say, JP Morgan, right? And our job is to work this particular company. So what JP Morgan wants us to do is they want us to drive the price up for this particular firm, this company. So they give us a certain amount of shares, and they also give us a certain amount of money to buy options with. What we're going to do is we're going to drive up this particular company by buying shares and decreasing the float and trying to buy this thing up. So we're going to trade this and try to push this share price up. What we're also going to do is we're going to buy call options. Why? Because what we want to do is as we push this up, we want the market maker to, one, have to either hedge it by buying more calls. And then what we also want to do is we want to get those particular shares at a lower price. So as we push it up, we want to be able to go into the options market and get those shares at a lower price, because once we push it up, we don't want to buy that market anymore. So if we start off at $100 and we're successful by buying shares over, let's say, a 2-week period, pushing this thing up to 130, and then we want to acquire a certain amount of more shares, we don't want to buy at 130. We will want to get those shares at where we started at 100. So when we start off, we go into the market and we start buying options contracts. So many times when you see an options suite, what I call a suite, which is a large amount of options contracts bought at one time for the same strike and the same expiration, many times what you're getting is an indication that a major move may be getting ready to come up. It may not happen today, it may not happen tomorrow. But when you see a lot of people start buying Tesla calls at a certain strike price going out a year, they're preparing for a move in Tesla. So they're trying to get their calls now, so then maybe late this summer, as they start to work that thing up, they already have their calls already in place, and they can also acquire shares out of the market for those particular calls. So this is how funds work the options market. So the majority of options activity has nothing to do with retail. The options market essentially is an insurance market. So let me give you another example. Let's say I'm gonna take a massive short position. Let's say I'm gonna take a massive short position on GameStop, right? So I'm short GameStop at 300. I start short selling it. So I start borrowing shares from my brokerage or from wherever they can acquire shares at. I sell them at 300 with the intent to buy them back at a later date. So as it's going down, I'm going up. But what I'm going to do is I'm going to hedge my position to where if this thing starts to turn against me, I don't lose all my capital. So what I do is I take a certain percentage of my particular capital, of my amount that I've allocated on this particular play, and I bought call options. Why? Because if this position goes against me, at least I made money on the call options, right? So I'm not totally out on the whole play. So what you'll see that is a lot of times short sellers will short a stock down, but they're also about call options to offset the shorting that do, just in case this play goes against us. Here's another example. Let's say we're very bullish on a company, right? So let's say I'm a pension fund. I'm really bullish on company XYZ. So let's say hypothetically Apple. So I'm really, really bullish on Apple. What I do is that I will take a sizable position in Apple. I have no intent on selling this particular position for, let's say, the next 5 years. But what I will also do is go into the put market and I will buy a certain amount of puts just in case something catastrophic happens in Apple and the share price goes down. I can offset my loss of my share value by having the put value increase, right? Then what I can do is sell those puts and take those puts to go buy more Apple. You understand what I'm trying to tell you? So what people that understand trading know how to do is you got to know how to work a position. It's not like buy and hold. Buying and holding is I just buy the stock and I just go to sleep on it. That's cool. There's nothing wrong with that. But the job of a trader is to work a position, because there are other people in the marketplace. They have their own goals. So you may be trying to push this thing up. Somebody else may be trying to push it down. You may be trying to push it up by 5%. Somebody else may be trying to push it up by 10%. Somebody else may be trying to push it up by 2%. Everybody's in this market trying to do what they're trying to do. You may have you may be in a swing trade. Somebody else may be in a day trade. So there's all these tools that are available to you in the market to try to move this particular stock the way you want to move it, and then offset the position or mitigate the risk that you've taken with your particular position. And the majority of it has nothing to do with the actual retail trader. So don't let somebody tell you that, well, if you're buying options contracts, right, you're taking a sucker's bet because of yada, 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 because they don't really know what they're talking about. And because the majority of options contracts are there for funds, they're there for big players, they're there for people that can take sizable plays. Like I said before, look at Apple's options chain. That doesn't represent retail. That represents institutions. It represents people that got millions and millions of dollars to take those particular positions. So if you go look at Apple's options chain right now, you'll see strikes that got 40,000 open interest on it. So you just take that actual amount of that particular contract and you multiply it by 40,000, and you know the value of that particular contract on that chain at that particular time. That doesn't represent retail dollars. Okay, we got retail chasing $25 and $30 stocks. So we know that those particular strikes don't represent retail, they're institutions. Okay, so now what I want you to understand is that when a person is selling you contracts as a retail person, they don't represent the options market. So 9 times out of 10, if you're going to buy a contract, you're buying a contract from a computer. Even if a person decides to sell contracts through their brokerage as an individual market maker, they represent probably less than 1% of the contracts being sold on a ticker that does a lot of volume. Now, if you're buying contracts on a particular options chain that has very little volume, you have very little open interest, you may be buying from an individual person. And that's why I always recommend to my students that if you don't see open interest over a certain number, I wouldn't buy there, because it's not a really, really liquid market, which means that you're going to have to deal with really, really wide spreads. But if you're looking at the SPY, you're looking at Apple, you're looking at Bank of America, you're looking at Tesla, you're most likely buying your contracts from a computer, and the conditions to buy were put in place by an institution. You're rarely going to be buying from an individual person. And that individual person, what they're going to be able to charge or sell their particular contracts from is going to be set by the market makers and set by the institutions, unless they want to keep their price so high above the market. And why would you buy a contract that's 30 or 40% over the market price when I could just go to the market and buy it at a particular discount compared to what that individual person is selling it for? So we have to stop letting people that really don't understand the mechanisms of the market, because you can't learn this at a college. Colleges don't produce traders. Traders produce traders, and firms that have trading desks, they produce traders. So I took principles of finance in college, right? I took, Chinese economics, but they don't teach trading, because you have to understand how to work a position. And it's a certain skill to it. It's a discretionary skill. There's a certain level of intuition. You got to understand who's in that particular market. You got to understand the other players. You got to kind of understand the macroeconomic conditions, the microeconomic conditions. You got to understand what's going on in that particular ticker to trade it properly. It's not that you can go read something in the book and memorize it and regurgitate it on the test and now think that you understand how the market actually moves. You understand me? So that's what people got to really understand, is that when I'm operating in the market as a retail trader, I represent probably less than 1% of the people that have a demand on options contracts. The demand for options contracts is coming from big institutions and big players, because they want to buy insurance against their movement in the actual market, right? They want a lot of times insure their position, or they think that this position is going to go very bullish, and they want to make sure I can still acquire shares at a lower price, which is also a form of insurance as this thing starts to go very bullish. And why is it going to be so bullish? Because we're going to use, one, our capital, but also our ability to create PR around a company to push this stock price up. So we know it's going to go up. Then we go in the options market. We get calls before we do that. So when it goes up, we can still acquire shares at a cheaper price. So that's why if you look at certain data, it can be an indication that the market is getting ready to be very bullish on a particular ticker, because you can start seeing options contracts in big amounts of contracts. I'm not talking about 1 or 2 contracts. I'm not talking about 1,000. I'm talking about people spending millions of dollars on contracts going way out into the future. They're setting up for plays in the future that they want to make take place, but they're locking their contracts in early. Or if you start to see that a lot of people are becoming bearish on a company, you'll see that their put options chain starts becoming very, very robust. That's not retail doing that. And so what we have to do is disassociate ourselves from understanding that retail cannot move a market, right? Retail didn't move AMC, funds did. Retail didn't move GME, funds did, right? There's no way in the world retail got GME to be $300, $400. Funds did that, right? So you got to really understand is that retail plays such a small amount of movement in the market. And so it doesn't matter what side that retail person is on. As an options trader, whether they're selling contracts, that's cool. There's nothing wrong with you trying to make a market, right? But what you got to understand is that there's nothing wrong with you trying to make a market. But I want you to understand is that that person essentially is less than probably 1% of the actual market. If you're buying contracts, there's nothing wrong with you trading on your own, but your influence on that market is going to be less than 1%, especially if you're entering into a robust market. And I always recommend to people to make sure that you're entering into a market that has already been established, instead of you trying to make a market by yourself, because you don't have the capital to do it. You don't have $10 million to make a market on a particular contract at a particular strike. You don't have that ability. So because you can't do that, you want to find out where a marketplace already exists, and then you just come in and you ride the trend of that particular market, and that's how you get in and you get out with your money, right? So that's what I want you to understand. Exactly, Kingston. So you see BlackRock bought 200 million of AMC prior. So that's what I'm saying. So I'm not against retail people making money on the play, but when you're looking at a float size of that big, AMC has almost 500 million shares. There's no way a bunch of people buying 2 and 3 shares is driving that thing up like that, right? It just doesn't work. But what institutions understand how to do is use retail for liquidity, right? So what they'll do is that they will push it up, let retail come in, create liquidity, and then they'll sell out of their position and retail gets stuck holding the bag. And that's why I always encourage people to take profit. Because what the institutions do is they push it up, they create the PR around it, then they use retail, right, to create liquidity for them so they can take their exit. And you've seen the same thing with securities, you see the same thing with cryptocurrency. It happens over and over again because the average retail person, they don't move until somebody else tells them to move, right? So if you was an AMC at $8, it don't make sense to sit in there when it's at 50. But if you got an AMC at 50, then you got to try to ride it to 70 for you to feel like it was worth your time. And that's how you get stuck in that particular play. And then now you're just dealing with the volatility of the play as opposed to taking your profit and getting out. So to reiterate, funds use options to work positions, right? They use them to work a position. Individuals can monetize plays in the options market, whether they're buying contracts and trading them, or whether they're actual writing cover calls and cover puts. But their influence on the market is relatively low. You're not making a sucker's bet by buying options contracts, because why are you making a sucker's bet with buying options contracts and another major player is buying $1 million worth of contracts? So you can be at a strike for a particular expiration date, and somebody has already bought $1 million of those actual contracts. You're buying 2 contracts. So why is it a sucker's bet when you bought 2 contracts, but it wasn't a sucker's bet when the person bought $1 million worth of contracts? And if somebody to me spends $1 million on something in the market, it's because they know something that I don't know about the play. And we got to understand, when you're talking about bigger operations and bigger funds, they have information about certain things that the average person doesn't have, because they got people on the ground, they got people inside companies, they know things about things. So there was a guy who gave an interview that said that they had people in China and they knew how bad COVID was because they had people in Wuhan. And once their people in Wuhan gave them an idea of what was going on in the market, they started buying massive put contracts on the SPY because they knew the SPY was getting ready to fall once that information came back to the United States about how bad that particular coronavirus thing is. So you got to understand is that when you see large institutions taking big positions in the options market, a lot of times that's an indication that something is getting ready to happen with that ticker, because they wouldn't be spending that kind of money if they just were going to lose the money because it's a sucker's bet. So hope this was valuable to you. Hope you got some value from it. If you want to kind of really understand how you can leverage the options market to create the income that you desire, to create the lifestyle that you desire, and to play this game like a savvy player and not get caught up in what a lot of these people are talking about on social media because they're trying to live stream or they're just trying to get a lot of attention, reach out to me about the highest paid part-time job in the world options trading course. But this course is going to be for somebody that has made a decision of what they want out of life. And then I can try to understand how I can help you get that. But if you're just looking for something, it may not be the right scenario for you. So hope this was valuable to you. This is David W. Williams, also known as Diamond Dave, and I'll talk to you later.